Hello and welcome everyone to the weekly Delphian meeting. Thank you for attending. So today we'll go through the regular kind of routine here. The market update. We'll answer questions that you guys have, and then Shawn's going to update us on the earnings season for Q3. See how that's going. So let's get started. So overall in the market, all the indices are still in state one. Just a note, we had a couple of data sets for DJX that we're trying to get fixed back in time. So it's just, so our programmers are working on that, in case you're wondering. It's kind of annoying. As far as overall market pulse, just slightly down from last week with the pie. I think we were around 70, so just slightly dropped. And then, the state ones were like 52. So we're pretty much the same kind of ballpark. So we'll go through the major indices here in a minute. Let's look at the market pulse overall. So you can see, we got up around 52, 53 here. It's kind of plateaued, not really much movement over the last week. Either way with the state ones or the state eights. Just a slight uptick on the lows yesterday. Nothing too big yet. We'd look for spikes for any kind of kind of notification that things are turning. So these are just kind of chugging along. We talked about last week. We're overbought as far as the state ones. 45. Is our overbought. It's not really, we're not really getting much movement up. It's kind of sideways and slightly down on these, so it's not. It's still not looking very, very bullish as far as that. The overall bullish bearish. It seems like we're kind of little exhausted on this bullish run up. We can see we got up around 70. That was last week, so we're slightly turning down. Not to say it's imminent, turnaround drop in the market. Just telling us that as like Sudhir had talked about, we look at trends as far as the green pie, the bullish bearish here. So, over the last week, we've had a slight decrease, which would be, slightly bearish. And I've noticed that, I track all the studies. So, usually I get a bunch of positions closing out each day. So, the past couple of days, I haven't really got any as far as, those portfolio alerts that I created. So, just kind of, I think Sudhir's right on with that, track kind of the trend on this, and it just seems to be slightly decreasing here, week over week, with the bearish, kind of increasing week over week. And these are the overall, 1, 3, 5, and 7 for the bullish, and then 2, 4, 6, 8 for the bearish. So, these are telling us a little different story than the other one, but it's something to be very careful of, just because we talked last week. All right, so everything's overbought. State ones are overbought by quite a bit, 52 versus the 45. And, we get up to the 70s on the bullish, pretty, that's a lot. Outside of, back when we had, some crazy times here above 80, that was post-pandemic. So, but normally, we get up around the 70. It's kind of, a tell as far as the market. So let's take a look at the indices. Last week we SPX, still in state one. Did a nice run up. Didn't really have a pullback like we normally do on these. Whoops, sorry. I'm moving too fast. Normally, we get a run up here, kind of pull back and then run. So this one did, the run all the way up and then pull back. So just a slight difference there. Obviously, the critical level here is this target 3 ran into resistance in that kind of area. This would be right about the average move in here. So we talked last week, watch out, see if we can get above that. We haven't really got above, that high from last week. Really got close to it and kind of turned around today so far. But this is going to be your key level here for your next level of resistance, 40. Let's call it 4740 for the SPX. So definitely watch that. We've already done the average move. So everything's as far as market pulse is showing kind of moderately bearish on that front. So just be careful, if it can't get above that, we expect it to pull back, that target 3 area. As far as support, your key lines here, your entry price 44, call it 44.90. As far as like the 50-day, that's about 4,500. So that obviously is a key level of support there. And right now that's kind of in no man's land between the entry price and target 1 here. So slightly above that entry price. So that's quite a bit, down to that, quite a bit of drop, 200 points down to that 50-day SMA line. So nothing real near-term support on that. Did kind of test that target 1 there on the way down. So, I can give that like a very slight support level. Those usually aren't very strong. So, if it tests that again and bounce off it, then, it could become strong support there. But the key here, the 50-day SMA, we're well above that. And we're having problems with target 3, which is kind of the normal. When we go into state ones, like I said, you go up, down, then kind of fail up and around that target 3 area. So be very careful. That's what I would say about that one. So let's look at the Russell. Russell's showing very similar. It did pop above that T3. So it's a little more of a typical pattern. State 1, it had a little run up, drop down, come up, and then fail. That's the typical pattern. So it doesn't happen every time, but we kind of model that just so you guys can plan a base case. So you can see that target 3 area, which is 2440, it had popped up above there. That this day right here and closed below. This one opened well above it, and it closed right above it. Next day hasn't been up there since. So obviously strong resistance up here. That's going to be your key level, target 3 on the upside, and obviously on the downside, the entry price, which is 2274.448 to be exact. So I'm not sure why it's going all the way out on those decimals, but just to be precise, I guess. So that's kind of the run around there. I guess we can look at the NDX real quick. I think it's more of the same here. It's nice though that they're all kind of matching. The Russell's been, I think that's a medium-term bullish trend when things are in alignment. This one didn't quite get up to the high levels of T3. Probably hit that average move though, right up in here. Probably hit the average move. So it looks like all of them hit the average moves, and they're running in the top end resistance. So. Just be careful, see if this can get above those levels. If not, then I'd expect, turn around on the market there, at least, short-term type of drop. So we'll have to see what happens. Overall, looking like we're broadly across the bases here, running into like a high level resistance. So, all right, well, I'll open up to questions, comments. I muted everyone, so if you want to talk, hit unmute. Anybody?
Hey, Josh, it's Joe. The one thing I would say is just, market ran so far quickly. Whether we're going higher or not remains to be seen, but I think it's just a natural pause because, we had been so far extended beyond the moving averages. So
yeah,
just
that's
kind
good.
of the natural movements of the market.
Yeah, I totally agree with that. And, like I said last week, this bullish party is going to be really hard to end before they start jacking up rates. I mean, that's obviously going to be, when and if they do that, it's going to be a real problem as far as the market. But until then, it's really hard to fight the Fed, even though, they're slightly tapering. So, like last week, the Fed meeting, they didn't even talk about raising rates. Like that wasn't even on their radar. And we've been talking for months and months about how this isn't transitory inflation, and that's come to be true, as you can see by each monthly readout of those, CPI, which they pull out a bunch of stuff of that anyway to try and make it look nicer, but it's really ugly as far as inflation, and I'm sure a lot of people are feeling that, groceries, rents, all that stuff. So.
I mean, the world is awash with cash. We see, all-time high prices damn near everywhere we look. So, maybe over the next, 6, 12, 18 months, we're going to get all-time high PE ratios in stocks,
yeah,
given earnings momentum at the same time. So, markets always go further than you expect in either direction.
That's true. And, someone last week brought up a great point. It's like, well, where else do you put your money? Bonds are terrible. Like who's gonna get a 3% coupon when, inflation's 6%, like where can you park your money? That's the only game in town, I think, outside of like real assets that will keep up with inflation.
I was going to comment on Joe's comment there on valuations being a little stretched. I think I wouldn't be surprised if we kind of bang around in all the major indexes right in between the 1 and 3 targets there in the green zone that you got there for a little while, just because that's, if people, the stocks are, after when they release earnings, if they're not beating on top and bottom line and raising guidance, their stocks aren't moving up. If they're lowering guidance, they're getting killed. And if they're not giving much change in guidance, but beating on the top and bottom line, they're not going anywhere there either. So I joined the bandwagon saying that, yeah, we're overbought in most areas. And until somebody starts to say, well, the real high pricers, the valuations are too high, when they start doing that, I think we'll start seeing a little bit drifting down, maybe into Q4 here. I don't know. We'll see. Retail says they're doing pretty good though. Retail's doing pretty good. So
yeah, I saw the thing from Target.
lots of money. That people are flush with money. That comment stands out well. Yeah, spend it while you can.
Yeah.
So be cautious. I agree with the be cautious there kind of mindset. That's why I'm being cautious.
Josh, Dan here. I got a comment.
Yeah.
I'm just wondering what the pressure is. I'm just throwing this out there as a question to everybody. With the valuations as lofty as they are, the market seems kind of frothy. But I think a lot of people are pensive going forward, but I wonder what the thought is on a lot of people about cashing out and paying capital gains this year rather than holding on to it, possibly going into a correction And then next year, the administration, if they increase their taxes, which that's been the rumor as well, on capital gains. I'm just wondering how many people, what the consensus is for, cashing out by the end of the year, paying capital gains at today's rate rather than waiting for the rates to pop up possibly next year. And what effect that would have on the overall market,
Oh, that'd definitely be,
you know?
that'd definitely drive things down, people liquidating to avoid taxes next year, if that goes through. It's always hard to speculate on what's going to actually pass through, the dysfunction in DC. I grew up there. It's just like a dysfunction town. Anyway, I'll open up to anyone else have, insights for Dan on, getting, their capital gains.
Yeah, this is Sudhir. I'm in the car. Hopefully you're not getting too much noise.
Oh, you're good.
But yeah, I agree with you, Josh. I'm not doing anything based on, hypotheticals on what happens in DC, right? Because a lot of different things you don't know until it passes. And then even when it does pass, let's say there's a capital gains increase, they may, delay it till, 2023 or something like that, right? So I don't think you can make an investment move based on a hypothetical. It may not even pass, right?
Yeah. Well, I know there was talk
I
about.
did have a couple of other points,
Yeah.
if you don't mind.
What's that?
I did have a couple other points
Yeah.
on the market, if you don't mind. One,
Yeah. Go.
I had brought. Can you hear me?
Yep.
Okay, so I had brought up a few calls ago that I read an analysis where the market is showing this pattern of pullbacks right before monthly OPEX,
Mhm.
monthly options expiration. And we're seeing that again, where the market pulled back and now it's up a little, but it's kind of gone flat. Monthly OPEX is November, this Friday, right?
Right.
And so maybe with Thanksgiving, it may delay, but if it's going to go back to uptrend, it would be, Monday or after Thanksgiving. We'll probably have a pretty slow week next week.
Yeah.
The other interesting thing is that Jerome Powell, there's a new Fed chair that's going to be appointed in January. And I saw a brief story that Biden is going to decide on the Fed chair, whether it's Powell, who wants to keep the job, or somebody else in the next 3 days.
Really?
Yeah, that he's going to announce who's going to be the Fed chair, because Powell's term is up in December, right?
Right.
So, and he wants to keep the job.
Right.
So I heard, and if Biden announces Powell, I would imagine that would be good with the markets. And if he announces somebody else, depending on who that person is, it may not be good with the markets, right?
Mhm.
And I read briefly in passing, I didn't have time to read the whole thing, that he's supposed to decide in the next 3 days.
I haven't heard that. I saw something on Yahoo Finance. They're floating some lady that's in the Fed. I forget her name.
Yeah, that's what I heard too. Same thing, Josh. And she's apparently more dovish than Powell. So that's what the article said. The one that you're looking for.
Yeah.
I read it too. But
Well, Powell was really dovish in 18 when he just started going crazy, raising the rates. So he definitely learned his lesson on that. But yeah, it'll be interesting. I'm not a huge fan of Powell. He's a lawyer, not with a financial background. So I don't know what he's actually doing there anyway. So It'll be
I don't know,
interesting.
you would think they'd keep Powell because if things don't go well, then you can blame Powell. But if you change right now and appoint somebody else and things don't go well, then it's like bad job on the choice there,
Mhm.
Mr. President. So there's that risk, I think, of changing right now. And I don't know why. I'd let sink or swim with Powell myself. He's already got us to where we are, and he can be the goat or the savior there.
Yeah, well, he was the last administration's choice, so,
Right.
yeah, I think that's part of it. But we'll see. I haven't heard that 3-day type thing, so that definitely be interesting for the markets, how they react to that, you know. They bring in a dovish lady, then you know, all bets are off on when the rates are going up. It's good points, Sudhir. Was that it?
Yeah, that's it.
Okay. Well, thanks for sharing in the comments, Dave. Anyone else before we let Shawn go? All right. Well, thank you. And Shawn, batter up.
All right, ready to go. So yeah, I'll share my screen. So give me 1 second. As always, takes me a minute. But I did want to just show, I've been working, over the past couple of weeks, just trying to get, all the earnings data within the virtual portfolios, within my virtual portfolios, accurate and correct, and just make sure I'm not missing any information in the virtual portfolios and things like that. I haven't been able to run a really detailed analysis, but I did finish, the bullish pre-runners today. So I do want to share that. Let me see. And kind of show you the initial just layout of the actual more specific results that we had last quarter, within the spreadsheet with the details of the profit factor, days in trades, averages, and things like that is to come. But this is just kind of a general overview of, my actual virtual portfolio. So let me go in and show you the trades that I have in there. And this is, again, just for the bullish pre-runners organizer virtual portfolio. And then I did the bullish pre-runners as a bull put spread. So currently no open positions in the bullish pre-runner category for, my virtual portfolio. Again, hopefully your accounts, if you're trading these, doesn't differ to a huge extent. And if it does, let's try to make sure we can look at it and see what the differences are, if there are any. But we can look at the summation of it. So the summation portfolio value, total portfolio value, $33,708. Available cash, it's all cash, and then starting capital, $30,000. So, when we shifted the trade design this recent quarter to the bull put spread, I was able to go in here and actually lower the starting capital to $30,000. I just tried to keep it as close to reality, or as close to almost being maxed out as I could. $100,000 previously seemed like it was just a little bit too much, and the percentages versus the starting capital, seemed to be a little skewed. So I just wanted to try to get it as close as I could. So that's the only reason that I changed it, from 100,000 to 30,000. No other specific reason other than that. And then you can see the portfolio creation date and the return on capital. If I go into my closed positions, that's where all of the positions are going to, show up. And then we can, look at the analysis, in more detail if we want to do so. The main thing that sticks out to me is, EXAS was a loser on the bull put spread. And then a big loser was Chipotle, lost $1,700. So we talked about it previously, trying to make sure we align the risk up within the virtual portfolio with what risk, we as investors would typically take. If I look through these positions, the main two that stick out, Shopify, obviously a $1,700 stock. The max risk on that trade was almost $15,000. So massive in the whole scheme of what I'm trying to do, and trying to track for everyone. And the same with Chipotle, $15,000 for Chipotle. So, all in all, total trades that ended up being confirmed at time of our pre-alert was 22. So I believe we had a total of 67 for our bullish pre-runners, and 22 were actually confirmed within the Delphian platform at the time of the trade. So we're looking at roughly, 1/3 of the trades where we're actually confirmed. So, as always, I mean, we're trying to find, a different source or a more accurate source or multiple sources to be able to get some of these trades that might have been missed to be confirmed, so we can, have them in there, because I do think we have a couple between like Microsoft and some other bigger companies that typically report, possibly on that third, Thursday of the month every quarter, but maybe they're just not confirmed as time of the trade comes out. So, again, we're just trying to be as accurate as we can and make sure we get that information to you. And, we're just every quarter, every week we're working on that to see if we can, offer some better data. So we're behind the scenes trying to do this for you guys, and for us too, obviously. So not only can we trade it, but we can test it and things like that too. So what I did want to show though, we can look at that and see, basically what I thought is if I take out Shopify, which is a big risk, $1,800, $1,900 winner, and I take out Chipotle, which is the same amount of risk, almost a $1,800 loser, those in theory offset each other, and then we should have roughly the one trade that's a loser, which is that EXAS. So really, we'd have we'd be 19 of 20, which would be an awesome win percentage based on this trade, trade strategy, trade setup. One thing that I did notice, and I haven't looked at it yet, but while Josh was talking, the market, the SPY, I'm looking at the SPY or SPY, it had a bottom around 10.4, so October 1st, October 4th, something to that effect. So a lot of these options that we're trading for this bullish pre-runner, this is the expiration date here. A lot of these options expire in December or January of next year. So really, these have a lot of time on them, and you can see that some of these we got into the 5th, or excuse me, right here, the 27th or the 24th of September. So just as the market was coming down, we started getting into some of these trades, and then we held it through the bottom, which was around the 10.4, 10.5 range. And like Joe and Josh alluded to a little bit ago, from 10.4, the market was around 425 on the SPY, and now we're at almost 470. So a big run up over the past couple of weeks since these trades started to get going. So really just kind of caught the timing really good on the way the market was trending. So what I mentioned to Joe earlier is what that got me thinking was that we do want to be a little cautious, I think, with what's happening in the market. But I think these trades kind of just show you that you can run some analysis and use some testing within Delphian to find great trades. And even though you might be a little more cautious or you might not want to put as much money at risk, it really shows you the validity of some of the back testing that you can do and some of the insight that this might be able to offer into the numbers, into the historical numbers of what these trades have done, and then maybe help that, cautiousness subside a little bit. Still be cautious, obviously you don't want to put all the eggs in one basket, but I think it really just shows a good way to say, hey, let me, if the numbers look good and the back testing looks good and I like the trade setup, putting some money to work in this environment isn't always necessarily bad. So looking at the virtual portfolio and anything I said, any comments, questions, please, let's keep talking as we have been. Anybody?
Yeah, Shawn, this is Winslow.
Yeah, Winslow.
Yeah, I had some thoughts about, because I was thinking, oh, it's terrible, you can't get confirmed trades. But if you look at it, the banks, the big banks, they all do it the first week. So I'm thinking that if you look at Josh's spreadsheet, there's a lot of stocks where you can get in anywhere from 10 days to 20 days and still make a decent amount of money. So it's not as, I don't think it's as critical, I guess, on certain stocks. So that I've backed off a little on that, and I would be willing. I missed the first week. I didn't do the banks, but that was I think they always appear then. So that was one thing. And then the other thing, and this is just a personal preference, but I'd sent an email to Josh about, well, I like to, on my bull puts, I want the I want to be in the money for the first
Right.
one. And so he told me to go back and check that out. So I did. I went back to the calendar and fussed with that. And I think sometimes it works, sometimes it doesn't. So that's just a word to the wise that your picks can be pretty damn huge in terms of the spread, and you're not making enough to make it worthwhile, or you're taking too much risk. But I think it's there's enough change or variability with a bull put to satisfy anyone's sort of level of risk. So I like the bull puts.
Good.
Um,
Yeah, I mean, I like them too. So I think it's a good change. And I
Well,
think to your exact.
Yeah,
ahead.
once you, the next one in the earnings season, I'm just going to go ahead and do as many as I can. And the only criteria I'm using to throw guys out is under the 200-day moving average, or if the 200-day is going down. Like I didn't take Zoom and I did not take Chewy because they just looked like garbage. So in
Right.
terms of the moving average. And I don't do, I did Google and I lost a little money on Google, but Google is like ridiculous. You can't limit the risk to $1,000. So,
Right.
and if you make the spread $5, you're sort of like not, you're not, it's not going to work too well. So anyway,
Right.
I'm encouraged because of the bull put, and I'm less teed off because we don't have enough confirmed ones. Like I'm going to take Bank of America and JP Morgan and whatever else, even though
Right.
it's estimated, because it's the first day, the first week.
Right.
So anyway, that's it. So I'm encouraged. So hopefully next time I'm going to take like 40 of them. I took 16, I think.
16. Okay.
And then I missed
Yeah, come up.
probably 5. So I
Right.
made, I was risking $1,000, and so I would have made 3,000, but I only made 2,000 because I missed the first banks.
Right.
Anyway, that's it.
That's
That's
still.
it.
Yeah. Well, no, that's fair. And yeah, you can see here, I put this is Josh's, or the list we compile. So you can see the Bank of America, has a bunch of variety of days there. And like you said, I think, if the optimal trade is, let's say 14 or 16 days, I'm not sure if that's it, but, really, still if you did, 11 days or 13 days, you're getting 90, you're getting a win percentage of 90% there, so still fair depending on when they're announcing it and things like that. So, I don't disagree. And I'm hoping that we can, find, not only a better source maybe where they have these confirmed dates sooner, which I just don't feel it's out there with some of the research that we've done. We might be able to improve it, but that's what we're trying to work on. But like you said, if Bank of America always reports, that first week, Tuesday, we're trying to get the IT group to be able to run almost like a screener within the platform to go back and say, Bank of America has, reported, 90% of the time on the first Tuesday of the month. And if we can get that validation of data, going back, 4 years or 2 years or 14 years, that will just help solidify some of these stocks. And again, Microsoft might switch, or Bank of America might switch next quarter just because of, the Fed announcement or the Fed raising rates or whatever it might be, right? But at least you still got that window of time possibly that you can put the trade in and still be within, these number of days. Because you can even see with Apple here, I think I had Apple up too. Apple, you can see Apple has 100% win rate, 15, 16, 17, 19, and 20 days out. 18 days, it's 90. I'm not sure how that lays in there, but you can see, anywhere between 15 to 20 days pre-earnings, you're sitting pretty good. And then even below the 15 days down to 10, you're still sitting at 90%. So,
Right.
That's a 2-week trading window that you have there. So, I think that offers a lot of flexibility, but, when we set it up, we have to kind of set these rules as they are in stone. and then say, hey, this is what we're doing. But, you can always make those adjustments as long as I feel you can make the adjustments anytime. I just want you to make sure I'm back tested and make sure the results are in line with what we have.
Yeah, the other point, and I'll just shut up. The other point is,
No, you're good.
The volume is crucial, and I look for open interest, and I just bite my tongue, and I throw an order out at the midpoint, and I'm going to get it or not. But I would say for some of these, like Apple Computer, I'm not going to limit myself to $1,000 or $2,000 risk. I'm going to do more because the bid-ask spread is better and the volume is better. Whereas stuff like Google is just like that's just even though Josh loves it, that's just like too much. So you look at I don't know, CSX or the other railroads, and they make money. They're okay, but there's no volume in some of those. So that's the other sort of criteria. I know I'm being a sucker as a retail investor, and so you don't want to do something that's not going to make, if the number you're going to make on your plan is like $150 or whatever for the last 10, that's okay because the risk is smaller, so therefore you would trade like 6 or 8 of these contracts. But then it's like, holy crow, you look at the you look at the thing and there's no volume there. So
right.
you might, and so instead of doing January, you look at December. I even did some in November. So it's like, we're at a disadvantage. Yeah, but some of this stuff is, you can do it. So
Yeah.
So I did okay. I had 3 losers and like I think 15 winners or 14 winners. So that was okay. I'm still encouraged. So that's it.
Yeah,
I'm gonna do the next one.
Yeah, good. Well, yeah, and I think you have the flexibility, of adjusting, the strategies if you want to sell the put that's in the money versus selling the put that's just right below below the market is fine. Again, as long as you test it. And I even think on some of these, I talked to somebody about the other day. I like the bull put spreads, but if the risk to reward setup and the back test is right, and I test it with just a long call strategy, the long call strategy might look a little better on Apple versus doing the bull put, just based on, like you said, maybe instead of doing a 1 lot, I can do a 3 lot, and then I can, I can get creative by scaling out and things like that. So those are always, options, for the lack of a better word, right? But I always make sure I'm like, all right, well, let me just test it first to make sure I'm thinking, right. And if it doesn't look good on the testing, then hey, I'm doing the bull puts all day long. But if it's going to offer me a little more flexibility, maybe another strategy might work a little better. But using Delphian to find that data is really what helps me. Any other comments, questions, anybody?
Yeah, I'll comment. This is Sudhir again. I think spreads have worked out a lot better. Now that we don't have pure long calls and long puts and stuff, so that's been good. And kudos to Winslow. I had forgotten about this sheet, and there might be some trades that I passed on because the earnings were estimated that I had forgotten this sheet was there that I could take because, even if the earnings are estimated, if, like you were showing with Apple, you have a lot of window there that you could still get in the trade and be above 80%. So that's interesting. I do pass on, as like Winslow was saying, you were saying Chipotle, and I forgot the other one that didn't work out. I pass on trades that I can't fit into my max risk profile. They all got to fit in the same risk profile for me. And so I know you have to track them all because, you have to track them all in earnings plan on the virtual portfolio. But
these outliers that require, 15,000 of risk and all that, I just pass on those trades.
Yeah, I agree. And I'm going to try to, coming quarters, separate them out and kind of keep them in separate portfolios. But yeah, usually kind of when I get in the morning, I get into the groove and I just get them in there and I'm like, oh, I should have did that. And I'm like, all right, next time. So I'm hoping to do that because, yeah, I think it's going to be more in line with what we want to do, because I'm in the same boat as well, right? I'm not going to do, the Shopify or the Chipotle trade with that much risk on there just to, to make $1,800 worth of profit. $1,800 of profit's nice, but I don't want to risk 15,000 to do so. So yeah, I totally agree. But yeah, the sheet's great. I mean, the testing's done, the numbers are there. We pulled out the best trade, but like you said, I mean, for Apple, you have how many choices here for Apple? You have, what is that, 11 choices for Apple. So 11 different days before the earnings announcement that you get into the trade. And, and still work out, 90% of the time based on the back testing. So, this profit factor obviously versus some of these is substantially different just based on the total, but you're still winning, in the back test, which is good. So. And then, so thanks for here. Thanks guys. What I want to show you too real quick is, so, kind of on the back of what we talked about last week, we're looking at some of these trades that we have done. I went back a little bit and I tried to see, so a lot of these trades we're getting in, like we talked about, the end of October, middle of October, and we're getting out the trades pretty quickly, the beginning of November. And a lot of these are, January and even December expiration. So I wanted to show an example of a trade that maybe the stock price moved, in a dramatic fashion. And then once it moves, so high to the upside that our bull put spread is so far away from the market that the interest in those options is really low. So meaning that if that spread is so far away from the market, nobody wants to mess with the spread because, like Qualcomm here, Qualcomm's at 181. If you're doing a 115 put, nobody's really looking at that 115 put because it's so far away from the market. And if you're trying to buy that or sell that, in my opinion, it's going to be really difficult because just nobody really wants it. Now, there might be some people out there that want it, but they're going to want it at a deep discount. So, I wanted to show that on the option chain so then we can hopefully get a visualization. Another one that came up that I looked at was Boyd, because Boyd Gaming is a lower price stock. So let me just show that real quick. So Boyd Gaming, we got out of the trade on 10/13. So I just want to pull that up real quick. So I'm going to duplicate this. I'm going to go into my option chain. I'm going to go to 10/13. So 10/13. And I'm going to pull up the Boyd. So I had Qualcomm already up. That's why I pulled up right there for us. And I think for Boyd, we did the December expiration. So I'm going to do December expiration. And now we can see, so for this trade on October 13th, when we got out of this position, we did the 60-55 put spread. So the 60-55 put spread is right here. So this is the 60, this is the 55. So pretty fair. You can see the bid-ask spread is, the bid-ask spread is pretty tight, not too out of whack. But just look, if the market was up like another $10 or so, we might be looking at some options that are similar to the 45 and the 40. And if you look at these options, the bid is 0. So there's nobody out there really that, wants to buy it, or if they do want to buy it, they want to buy it for nothing. So, or, barely anything for the most part, right? So if you have one of those options and you're actually trying to, let's say, sell that option, you're probably not going to get anybody that's interested in it, even though the open interest is, let's say 497, right? So, you really need to look at that, in my opinion, when you're trying to get out of some of these trades, because if that bid is 0, then there might not be anybody that wants to get on that side of the trade. So your best strategy at that point could either be let the trade expire, which is somewhat risky, right? If the market sells off and the stock sells off, or calculate into your risk, profit profile, how much would it affect the profit of the trade if I just buy back my short option and leave the long option out there because they're not wanting to give me anything. So how much is that going to affect it if I just buy my option that's putting the risk on the trade, the short option? What happens if I buy that back? It might drop your profit percentage from 25% maybe to 15%. So you're going to drop your profit percentage down, but you're removing all of, essentially all of the risk from the trade, and you're not getting out of the trade completely, but you are pretty much covering your risk. So you're still making a profit, and you can kind of walk away from the trade. And then you can always set a limit order to sell that put that's way out of the money for something if something ever happens and Boyd Gaming goes down. So that's something that's always, again, an option, if you will. So anybody have any questions on that? Comments?
No, but I have a comment
Shawn?
on. Oh, sorry. Go ahead.
Go
Joe.
ahead, Dave. Yep,
Okay,
go for
I'll
it.
go ahead. I'll go ahead then. A lot of times, when I'm using naked puts to acquire shares, instead of just selling the all-out naked put, I'll go down, just do what you just did. I'll look to see where there's a no bid, and that's why I'll put my I'll put my buy to cover, because it just limits the amount of capital you got to spend, and you're still getting like all you can get as far as the premium goes on the short that you're
Right.
selling. So yeah, I do just that. Maybe I'll sell something close to the money and then go down to where it starts to say zero and say, okay, and that'll get me in pretty reduced at a discount if I get filled. If stock drops that far. So
Right. So what you're saying is, like, in this instance, if you sell to 65, because you might want to buy it at 65 if you have to, you're going to have risk all the way, in theory, down to zero, right? You have your risk all the way to zero. But to say, hey, I only have $2,000 worth of risk, then I'll buy the 45 at,
yeah, even if it's a no bid, just because it limits the amount of capital you got to spend for it. Yep, just that.
Sure,
Yep,
sure.
exactly what I do.
So you're spending $1 or whatever, but it's reducing your risk substantially. If the stock does want to start tanking in a big way, so that's fair. That's a good idea.
Yeah, right.
Shawn, the
Joe,
only thing I was going to say,
Yep.
yeah, just that, we don't actually have a theoretical value column, in our option chain. That midpoint, I guess, can almost be thought of as a theoretical value, although that's not really accurate because you don't know what implied volatility is driving that pricing. But I think it might be something we'll consider adding down the road to give people kind of a guidepost as to how far they have to trade away from theoretical value to either open or close, one of these out of the money positions. I still think for the most part, the market makers, they trade around theoretical value. So even though, like that one example you mentioned, I think it was the 115 strike with the stock in the 180s, if you, pay a little bit above theoretical value, chances are you're going to get executed in this marketplace of electronic trading.
Right. That's very true as well, for sure. I don't disagree. And I think too, that's where, and you can speak to this as well. I think sometimes that's where, and I can't tell everybody how to trade, right? But I feel that if you have the flexibility on these trades and you are stuck in the trade, for the lack of a better word, right? Like, you can get creative and buy one back and then try to sell the other as two separate transactions. And that might alleviate some of that. I don't know, does the electronic or do the market makers see the spread differently than they would see the individual options? I guess they might be more apt to fill the individuals versus the spread. Does that sound correct or no?
I think it's a question of, how much theoretical edge do they think they can get? And, do they really, that's, I think, what it comes to. And then it gets back to this whole issue of liquidity that we talk about all the time, and how we pare down, the 5,000 issues to around 300 in terms of the liquidity list. The more active issues, it shouldn't take that much above theoretical value to get executed. But, I guess every day's different, unfortunately.
All right. Yeah, fair enough. And yeah, I think, in this instance, we're still sitting pretty close to the market. But, the point was, if you're doing I can't remember which one we did, right? The Boyd, we did the 60 and the 55, so the 60's here. If the stock, goes up, or the 55's here, if the stock goes up $10, which is a lot on Boyd, now we're looking almost at like a 45 put, which again is almost, zero, but theoretical might be around 15 cents. But yeah, let me show you guys this other one. So yeah, the one that you had mentioned, Joe, is the Qualcomm. You can see Qualcomm went up 127 to 181. So we did the December 17th, 130, 115. So let me do Qualcomm. And then we did the December, the 130, the 130, 115. So this is the 130, 115. And so still, when I'm looking to get out of this trade, which I got out of that trade on 10/21. So if I go into my calendar and I go to 10/21, the stock's at 133. Again, I'm switching, I'm sorry, because I don't remember. 130, 115. So 130, 115 is right here, right? So we're looking at these two options here. Decent amount of open interest, decent amount of open interest and volume on these. And we got a pretty decent bid-ask spread, right? We're talking about, the bid-ask on the 115 is 110 at 114, then the 130 is 440 at 450. So, a couple days later after getting into the trade, I shouldn't have a hard time getting out of this position because I'm still fairly near the market. The stock has went up, but, the volume and open interest is there. But if I do move ahead in time, even moving ahead in time now, look at the stock now, it's at 181. My options aren't even showing on the option chain. So let me go to all, and we did the 130, 115. So even here, all the way, the stock's at 181. We got into it around 130, but we can still look. I mean, we still got open interest on the 130, and we still have some good open interest on the 115. So even going, we got 30 days left into expiration. We still have, I think, in my opinion, enough, spread difference and enough open interest in the options that we should be able to get out of this trade, fairly easily. So not only is the stock, 33% above where it was when we, got into the trade, and we're, only 30 days to expiration, we still shouldn't have a problem getting out of this spread, if we had to close the spread from the bullish pre-runner. And again, I feel that, if we're doing as a spread, you're talking what? The mid price here is 16 and the mid price here is 6. So in theory, 10, 12 cents or so is what you could try to close the trade for. If you had to close just the short side, you might have to pay 18 cents to close the short side, but you're taking all the risk off the trade. So that's where you can just get a little creative, I think, in my mind, if you are having an issue. So just kind of keep an open mind, keep calm when you're trying to figure these trades out. And I think if you do that, you can find some really good exit strategies. And again, the virtual portfolio is going to pull you out, at the closing price, because that's what the virtual portfolio does. It's not sending it to a market maker and they're saying, I don't want to deal with this trade. But I feel that if you use the virtual portfolio for trading like that, that can at least give you some expectations, hopefully, of, why, what's going on with this trade? Why did I get maybe a bad fill? And then you could come in here and say, okay, I tried to trade this option here that only has an open interest of 19 and, a zero bid. That's why I'm getting a problem. And you're not, trading live money. You're actually able to get in here and methodically think about what you're doing. So just kind of piggybacking what we were talking about last week. Comments, questions, anybody?
Shawn, just one thing I would add is,
Yes.
when people get, like Dave, you trade the semis, I would guess you have a pretty good sense of how much you have to give up to get out of a trade. Most pits have their own personality in terms of liquidity, whether the guys are aggressive or not aggressive. And if you get to trade the same issue repeatedly, you're going to get a sense for whether it's going to cost you 5 cents, 10 cents, 20 cents above theoretical value to get in and out of these trades. And that's valuable information. But I think point is, a lot of pits kind of have their own personality in terms of how aggressive they are, making trades. That's all.
Yeah, that's fair. And I think, like you said, too, their edge, what edge do they think they have? And obviously, if they think they have a better edge, then they're going to take it for sure. So, yeah, that's a great point, too.
And that edge is all around their theoretical value. The theoretical value will change over the course of the day, but typically not that much, because those theoretical values change primarily because of a change in implied volatility. And implieds change, which is the fun part of options, but typically not that much over the course of just one day.
Right. Yeah, I think like to that point, like I mentioned before, when I traded options on commodities, we would call down and I could get a quote on a spread, like a 4-legged spread would be one, and then I could get a quote on like all the legs individually, and I would come up with a different price, and then I would call down and try to say, well, that's the price you gave me on all individuals, and then they would say, no, that's different, and it's the same options, but they know the trade is constructed different. So I think they figure the theoretical value of the individual options might be a little different than the theoretical value of the trade as a whole, or the 4-legged spread. So they're looking at that in different ways to figure out how they can make a buck, which we are doing too. So.
Hey, Shawn, would you normally take the trade when you have such low open interest of 19 and the volume is 0?
That's a 70 strike, so that's the start's at 181. But no,
I was thinking of
would.
like with Boyd. I mean, that one.
Right. That one was a little bit lower. Yeah, that was a little bit. This one's a little bit lower. Like you said, we looked at these. I think it was around the 60-55. So 331 to 182. Those are pretty close, right? I would want to be careful on some of those with that open interest being that low, but again, like Joe said, I've traded Boyd before and I didn't really have a problem getting in and out of the trade. So I kind of remember feeling comfortable doing that. But like Joe said, I think if you trade it once and you get stuck, then that's where you're going to remember it. I remember trading Regeneron before, and I think the stock is better now with the option values, but I remember, I was down, like after getting filled on the trade, I think I was already down 30% off settlement. And you're like, whoa, I already lost 30% on this trade. And even I think the trade ended up making money, right? Because when it starts trading during the day, the settlement prices versus the intraday trading is different. But yeah, you always want to be careful because I think, like Joe said, you feel for some of them that you can trade and you kind of get it. But yeah, if it's a little bit lower like this, I would say, under 500 or so, I try to be a little bit careful on those because, if it's 100 open interest and you're trading a 5 lot, you're 5% of that open interest in that particular option. So it's something you got to be a little concerned with.
So the point.
But most of the ones. Oh, go ahead. No, go ahead.
So you're looking at the number of like 150 and 200. Anything above that for open interest would be okay.
Yeah, I'm usually looking at like 500 or so is my open interest, what I'm trying to figure out. About 500 on the open interest if I'm trading that particular option. And if I come in and I see the volume 0, that like for this one here, this 45, I might be like, oh, all right, you got 500 open interest, I'd say, but you got 0 volume. That could be a problem too, because I'm the only person out there that's wanting to trade that particular option at that particular time, right? And you can see the bid on this one 0. So that might lead you to show you why that volume is near 0. Even some of these are 0 here. But yeah, I would just try to keep it at 500. I mean, we use that screener, and that's just my personal opinion. But when we use that screener to set these trades up, we're trying to use open interest and volume as one of those criteria. So we're trying to make sure we don't get ourselves in those predicaments of some of those trades. But I feel if you see one that you're questioning, it might be better to test it further or just pass on it because, like I said, that's just one thing that just discourages you from trading. And you've talked about it before in the past couple of weeks where you've had a hard time getting out of some of these trades. And, there's not much worse than me getting into a trade, making a profit, and then not being able to close the position. It's like that was just all for naught. And now I'm just really struggling to figure this out. So I would prefer to try to alleviate that from you, so you don't have to experience that anymore.
Okay,
but we try. And again, some of them come in, I think like Joe and Josh had mentioned, depending on the expiration date, and we're doing these a couple months out. So some of these expirations might not be as active as the others. And if it's not, it just might be pulling in that next expiration that's not as active. So, that's just something to pay attention to. I mean, if I'm looking at December, I would think would be a pretty good month. But if I go to January, it's pretty much the same. Say March should be a little more. I mean, they're all the same. Boyd Gaming is a pretty small value stock. I mean, talking about price wise, so their options might not be as heavily traded, but you know, I would try to stick to above 500 at least if you can. And again, that's just my personal opinion. So. And then, yeah, and then so like somebody mentioned earlier, you know, you always have the ability, you know, if we're looking at a different strike, you know, if you're looking at this January strike, but you say that's too far out or it's too close or there's not enough open interest, look at some of the strikes around it. And then if you find one around it, and if the days are a little bit short, you know, try to back test using that number of days or something close to that number of days to see if that can produce similar results, and it can. If it can, then great. So that you always have that ability to take what we've provided and, you know, expand on it further and adjust it more towards your trading. So yeah, well, that's all I had, Josh. You know, again, I appreciate everybody listening to me, and, you know, any questions or comments, feel free to shoot me an email, but, you know, I hope you guys took something away. So thanks.
Thanks, Shawn.
Thanks, Shawn. And, you know,
Yeah, thank you guys.